Hello, everyone. Georgina Zanetos here at Kaya Association. We're here today to discuss infrastructure, an asset class that has emerged of increasing interest amongst both institutional and retail investors. While investments in the space are typically long term, the conditions surrounding them can change overnight. When directions change, we're speaking with Peter Blue, head of private market solutions at Franklin Templeton Investment Solutions and Kaya member, about navigating pivots in infrastructure, reassessing long term assumptions, and leading when the path forward isn't always linear. First of all, Peter, thank you very much for being here with us today. A lot has changed in the infrastructure space over the last 18 months. And how would you say the investable definition of infrastructure evolved beyond traditional views of bond like and defensive assets? And what does that evolution really imply for how investors should think about risk, return, and portfolio construction today?
Yeah, thanks, Georgina, for having me. Appreciate the time and the opportunity. Good question to start with. I think what we're seeing today is a shift in the definition of infrastructure as institutional investors look at it. Right, classically, it is thought of as more bond-like and higher income, but that's really a byproduct of how the asset class developed and originated over the past 20 or 30 years. So coming out of the 90s into the early 2000s, it was really more about privatization of government assets, public-private partnerships, assets that did lend themselves to being a bit more conservative, highly regulated, and kind of locked in cash flows in a way. So think utilities, traditional transport assets like roads and airports and seaports, the things that most investors tend to think about when they define infrastructure. Um, but today we're seeing a massive shift in the opportunity set for infrastructure investors. Beginning around 2010 into today, private capital has really come into that to the broader market and expanded the scope of what's possible. So new sectors like digital infrastructure, innovation and energy generation markets, really in some cases moving governments entirely out of the equation, which leads to different challenges as an investor when you think about the space, right? So it's not just now a government regulated monopolistic asset. It's a few different dimensions and lenses through which you have to now look at infrastructure. And the way we think about it is, you kind of have to look at what is the asset type in the sector, utilities, digital, transport, energy, social. What's the fundamental asset itself? What are the cash flows associated with it, right? Because now you can certainly have government contracted revenues, but it may be a long-term PPA in the contracted private sector space. That can still be infrastructure. You just have to assess the counterparty and does the cash flow have infrastructure-like characteristics? And then lastly, um, there are different types of strategies that have developed over time as private capital has come in and expanded. So there's core plus, value add, and opportunistic. And all of this speaks to your question, a need to take a multidimensional lens when doing portfolio construction, right? We have to kind of segment the universe of assets, strategies, risks. What type of cash flow risk am I comfortable with, fully contracted versus merchant versus commodity, for instance? Um, and it does add complexity to the portfolio construction topic because now we have to slice and dice and understand what risk we want in the portfolio and what's the balance. And it may be core for certain types of investors who prefer yield and lower, more defensive returns. Um, but many investors want and are seeking the higher return, core plus, value add, kind of growth infrastructure profile. And so truly it's much more interesting today, I think, in terms of the opportunity set, but it does provide another layer of challenges for the portfolio manager and investor.
Sure. So you spoke about, sectioning off different types of assets. And, I think one of those sections that everyone talks about is renewables. But the real constraint now is the grid, right? And especially here in the US, where are you seeing the biggest bottlenecks in US energy infrastructure? We hear a lot of talk about generation. Is it transmission or storage? Where are you seeing the biggest challenges?
Yeah, it's a timely topic. Certainly very relevant for a number of stakeholders today. I do think it's in the transmission space, and really kind of a counterpart to that is the need for dispatchable energy that can come online quickly to fill the gaps and kind of smooth out pricing throughout the day and the supply of energy to the grid throughout the day. And that would speak to storage in some sense as a solution, potential solution for it, amongst others. Today the interconnection queues are they could be 4 or 5 years even for new utility scale projects. Um, and currently in the pipeline in those queues, there's hundreds of gigawatts of power generation and storage waiting to connect. And so, that would speak to the ability to, or rather the need to increase the throughput of the grid itself, which is really the transmission and distribution capabilities um, that are available for it. Permitting is a part of the delay. Multi-layered approvals across federal, state, local municipalities can kind of drag things out for quite a while and delay energy from coming online. And it is creating grid strain now as we have this backlog of gigawatt power, trying to get on the grid. And then on the other side of it, you have new power demands, right, of data centers in particular, which are putting stress on the grid as well. Um, so I think there's a few different things going on here. Historically, there hasn't been as much capex as was probably needed into the grid and utility systems. There's a variety of reasons for that. Um, One is just the need to kind of keep utility prices low for the end user. So regulatory and political environment tended to prefer kind of a lower capex approach, controlled growth and regulated asset base of utilities, which then leads to a kind of a controlled ROE to those assets, which effectively is the end price the users are paying. So you saw underinvestment in a lot of this over time, but now you're seeing the other side of it where power prices and utility prices are increasing because of this constrained supply and the increased demand. And so, we'll see. It'll be interesting to monitor. I think kind of the regulatory and political landscape is shifting quickly because of that. Um, and we're likely to see more innovation and hopefully more capex and kind of throughput capacity coming into the transmission systems to resolve it over time.
So, in energy infrastructure specifically, where are you seeing the most mispriced opportunity? So, meaning where one investor's intention is still stuck in the headlines, but the real value might be somewhere else.
Yeah, it's a good question, Georgina. I think in the U.S. in particular, gas and nuclear get a lot of the headlines in the energy space as potential solutions. Um, and definitely areas that need further investigation and further development. The a constraint with those two solutions is just the time to bring them online into the market and provide utility scale base load to the market. So with gas, one of the issues is turbines are massively constrained, and so supplies needed to bring a new gas power plant online, just like interconnection queues, it's a multi-year process. Um, and so there are real practical, real world constraints that just kind of bringing online more gas. I think there's some solutions on the margin, right? Like retrofitting existing power plants and trying to take assets that exist today, make them fit for purpose, but just expanding on the basis of new gas power plants can be a challenge. Then nuclear, we think it's 10 years out to make it a scalable solution. There still needs to be some technology innovation to allow that to happen. Not to mention just the permitting and kind of local concerns communities have to that solution. So certainly part of the longer term playbook, but near term less bankable than I think the headlines would suggest. And so that takes me to energy transition assets, where it's kind of the opposite. The headlines would suggest not as much opportunity, but there actually are a number of bankable projects across the states where you kind of look at a layer deeper. And that's where the near term economic opportunities really are. They're quicker to market, they're lower cost to market. You have to pick your spots, right? offshore wind, in particular, U.S. is there's just a ton of political uncertainty with it, so it's tougher to underwrite for new projects. Um, but there are a number of solutions that are very clearly kind of bankable in the sense of estimating cash flows. Storage is one of those, which we kind of briefly touched on as a grid solution. Solar is still very bankable, particularly when it's attached to projects like massive data center grids, um, or development projects that can be multi-gigawatt projects themselves. So what we see is at the state level, states are taking kind of an all the above approach to bring energy online and securing their energy future. And it's not just gas, it's not just nuclear, and it's not just energy transition. Um, it's kind of an all the above approach, which means, some of the areas that have been in the headlines for as a solution like gas, nuclear, they may not be as viable in the near term as the other approaches that are available and ready to bring online. And there's a lot of focus to do so in a thoughtful way. So those are the types of projects that I would encourage investors just to kind of dig through it. I think it's project by project. There's idiosyncratic risks. So like anything else in infrastructure, you have to get comfortable with the offtake risk, with development risks, the regulations around it. But if you really kind of look through it and go project by project, there are plenty of bankable opportunities across the energy transition landscape in the US.
So
So
you spoke before about one of the constraints being, these data centers, and especially in the U.S. Um, Overall, the constraint being on the grid, but digital infrastructure, meaning these massive data center fiber networks, towers, has essentially become very important to economic growth. So, how do you evaluate digital infrastructure differently from traditional energy or transport infrastructure in terms of risk, return, and ultimately durability of cash flows?
yeah, I mean it's digital and data centers in particular. Um, a ton of capital formation happening there, a ton of capex. Obviously, there's the AI headlines every day that seem to kind of whipsaw sentiment. So it's critically important to have a process in place to look at these assets and decide, what the risks are and then what the return opportunities are, and then also where it fits in a portfolio. Um, so I think it's still important to look at data center projects specifically in terms of brownfield versus greenfield risks. Are they operating? Do they have locked in cash flows? Are they stabilized in that sense? And you can kind of, if you bucket it in that brownfield category, it's easier to wrap your head around. It becomes more core plus, and you kind of go about validating those assumptions and digging into the cash flow stability. Greenfield will entail a bit more development, expansion, capex, growth orientation. It could be greenfield, from the shovel in the ground, but it could be more brownfield expansion, which will kind of tack on some greenfield efforts to expand the platform and do new development off of it. So, I think you still have to look at those two categories of risk, which will entail different risk return profiles. But for digital and data centers in particular, there's probably three more that come to mind as particularly relevant, right? So execution risk is critical in the data center space, particularly for new developments. And the big thing there is the power secured? Is it locked in? Is there a path to grid connection, or if not, is there a path to a behind the meter solution where a project and the power generation capability can be stood up just for your development? So is the power secured? Do you have local community and stakeholder buy-in? That's a big one. Just the local, not even the regulators, but in a world of NIMBYism, and making sure neighborhoods and community leaders appreciate what you're doing, and that you're doing in a way that's thoughtful and ultimately beneficial to the community. That's important. And then beyond that, just the supply chain requirements to execute. on the labor, construction, materials, etc. So execution risk is a big one. That's one area that, as an aside, where we suspect many new entrants to the data center space will kind of trip up because it's one thing to have a piece of land and get that ready and permitted for a data center, and that's critical as a starting point. But without the power, without the ability to build, without the
Right.
community buy-in, it becomes tough. Um, the second one is offtake becomes a little bit trickier and different in the data center space. So, who is on the other side of the long-term contracts that the data centers want to put in place, whether that's with hyperscalers who have locked in 10 to 15-year contracts to use the data center compute, um, whether that's enterprise corporate entities. Um, what is the model? Is it a co-location model? Is it more of a neo cloud model? So understanding the nature of who's on the other end of the contract is pretty important. And that kind of leads me in the next one of technology risk as the third consideration to really think through. Because the nature of the businesses of a lot of the off takers is changing quickly. Whether it's AI and the hyperscalers and their ability to scale capex and monetize, or whether it's just the need for cloud at the enterprise level. There's rapid shifts in that type of demand profile. And so when you're underwriting the data center, it's the key things that come to mind is the risk of retrofit, underwritten, understood, new capex. Is that built into the financial plan if the data center needs to change its setup and specs for a different type of buyer halfway through its life? What would that entail? And then what happens if counterparties need to be switched out? If one hyperscaler loses market share and another one gains, is that easy to do? Is it easy to make the contracts fungible? Based on what you're able to provide to the market from a technology and compute perspective. So I think the key thing there to summarize it is, in addition to the ability to execute and actually bring the data center online and secure offtake, it's important to have optionality in what the data center can do and how it can accommodate different types of technology, and that's thoughtfully kind of built into the project plan in advance, so that ultimately you can underwrite the cash flows as an investor and try to get comfortable with it.
So switching gears here a little bit, talking about Europe, European energy policy has been heavily shaped by decarbonization mandates and energy security concerns, especially post 2022. In the US, though, incentives have been more market driven through legislation like the IRA. How do these differing policy frameworks affect private capital deployment into energy infrastructure?
Yeah, that's a good topic itself. I think I like this term bankable. I think projects can be bankable in both the US and Europe under these different policy dynamics. What really matters most is being able to underwrite the project and being able to understand the cash flows and the risk associated with it. So in Europe, there is a bit more top-down coordination in terms of the mandates and the direction of travel in terms of energy policy. Um, it's a bit more stable in that sense than what we see at the federal level in the US, but there's execution risk at the country by country level within Europe. So each country is going to have its own preferences in terms of the forms of energy, where it wants to spend its political capital and time and resourcing to direct, energy transition efforts, if you will, and promote energy security more broadly. And so, while you have this kind of umbrella of a layer of certainty as a private allocator in Europe, you still need to navigate country by country and make sure you understand the dynamics and really go again project by project to ensure that you're comfortable. US is slightly different, in terms of its approach with the federal incentives, which is very helpful as a way to mobilize capital because you can underwrite that and include it into kind of your cost of capital. but it also comes with uncertainty due to political cycles. So we just saw that over the past two administrations, where one administration had a stance, and promoted the IRA, which included various incentives, and then the next one, kind of changes course with one big beautiful bill, right? And so policy based on the administration can shift quickly in the U.S. 4 years really isn't that much time,
Right.
in the grand scheme of things. So it helps at the moment unlock capital and provide direction. But there's also the uncertainty in the back of everyone's mind of what's the longevity behind these policies, how ironclad are they, um, can they change quickly? That requires a little bit of a layer policy review to get comfortable with any subsidies or incentives, which some are longer term and fairly certain. Others could change relatively quickly. So it's just a different type of risk. Both approaches having more of a top down push, that can mobilize capital. In the U.S., the incentive structure can certainly help, um, and that gets directly underwritten into projects. It's just more about as a private allocator, being comfortable with the risks associated with the environment, and probably more than anything, it speaks to global diversification. Quite honestly, and having a balance of exposures across multiple regimes, political cycles, um, and regions to kind of protect yourself against changes in any one dynamic.
And I guess kind of tagging on to that, it's hard to have a conversation around infrastructure without having a comparative conversation, right, between the U.S. and kind of the rest of the market, because the U.S. has one of the deepest pools of private capital for infrastructure investing, yet it still lags behind many developed countries in areas like high-speed rail, grid resilience, and broadband penetration. So, why do you think the U.S. is behind in widespread adoption despite abundant capital? And what needs to change for investments to translate into faster build out?
Yeah, I mean that's the follow-on question, right? Why haven't we been able to do more and mobilize more? Things like high-speed trains and some of the more modern infrastructure we see in Europe hasn't quite taken place in scale in the U.S. There's a few different issues. We touch upon some of them in the context of energy. So certainly, this multi-layered approval process, particularly when a project spans multiple states, that can be complicated and time consuming. And the backlogs that come from that can just delay projects kind of endlessly. So massive projects that will go across state lines and require a lot of capex, a lot of coordination. It's just very difficult in practice to align the stars to make it work between the regulatory bodies and environment, kind of the political environment, private communities, and then the capital providers and construction and development to execute on it. So there are a lot of headwinds that just kind of make it hard to unlock that private capital. Um, and there are other bankable projects that I think private allocators tend to focus on instead. So if the public policy incentives aren't there to do a new effort like a high speed train, when you think about that, it's got to be funded by some combination of private capital and probably taxpayer money as well. And if the taxpayer money isn't there because of budget constraints, then that's going to put more pressure on private capital, and that's likely not something that private capital will prioritize. Without more government certainty and public policy in place to secure confidence around what will be a multi-year process and a lot of capex that goes into it. So the execution environment just isn't quite there right now. And what that trickles down to is, uncertainty in the project in terms of risk transfer. So what risks are owned um, by the public market, by governments, and in turn, people and the taxpayers behind the government? What risks are taken on by the private investors and kind of the LPGP community, and then what risks are taken on by um, the construction, development, and kind of supply chain component of bringing these projects online. When those sands shift in terms of who owns what and where the where things like construction delays or policy change or um, regulatory environment change or even capital market shifts like the financing environment, interest rates, kind of the GDP environment. When these things are all moving targets, it just becomes quick to allocate capital and scale. And so what you see is what's happening now. It's more of a prioritization of projects that kind of are ready to be shovel in the ground. So that's a lot of that's in digital today. A lot of that is in energy transition globally, where there's a clear offtake. There's a clear playbook on how to develop and execute these projects. There's pretty clear certainty around kind of what it takes to get a regulator and public um, or local government approval. And so when that playbook is in place, that's where capital is going to flow to. These more innovative projects that are kind of really the bigger scale projects, they need all hands on deck in terms of involvement from governments, taxpayers, GPLP, and the suppliers to really make it work. And it just, when so much is changing all the time, it's tough to mobilize it.
And it sounds like if a private investor has so many other options, especially here in the United States where the breadth of private markets is vast, why get involved with all the problems if they can just easily allocate somewhere else where the rule book is a little more easier to navigate, right?
Yeah, I think that's it. I mean, it's kind of economics 101 and market incentives, right? The capital will go where it's going to be treated the best effectively. And so we'll see. I mean, I think as public infrastructure, we've been saying for decades that it needs to be upgraded and improved. Yeah, I think that pressure will continue to increase and grow. And I'm optimistic that between the public and private markets, innovative solutions will come about to unlock that capital, get that work done. And we've seen efforts over the past couple of administrations to try to do that. So we're likely to see more of it and hopefully pave the way for more growth and actual execution.
Wonderful. Well, that's about all the time we have for today. But Peter, thank you again for being with us today and for a very interesting conversation. And thank you all for tuning in.
Thanks, Georgina. Appreciate it.